If you have a business, especially if you're an S corporation owner and you report inventory, well, in this video, I'm going to blow your mind. I'm going to show you how you can deduct your inventory 100%. Additionally, at the end of the video, I will show you step-by-step instruction that you can do this without involving your accountant. And the best part of this all, you can still do it for previous year's taxes if you still haven't filed last year's tax return. Ready? Let's get started. Hey, thanks so much for watching this video on my YouTube channel. My name is Boris Musheyev. I'm a CPA and a tax strategist. Every week, I release a tax strategy video here on YouTube. For you, the profitable business owner, my goal is to completely simplify this tax strategy so that you can understand it. At the same time, you're able to go ahead and implement this tax strategy, or at least take it to your accountant so he can implement it for you. But if you don't have a tax advisor, you gotta get yourself a tax advisor so these tax strategies could be implemented for you in your business. Thank you so much. Don't forget to subscribe if you love the video. Let's go ahead and start saving you money on taxes. Okay, welcome back to my Blackboard. A really cool strategy. Before we understand the new way, we have to quickly take a look at the old way, okay? So before the Tax Cuts and Jobs Act was enacted, the way that inventory worked on the Section 471 rules is that when you buy inventory, right, if you only sold $30,000 worth of inventory, then your ending inventory is $70,000, right? So 100 minus 30, you have 70. But what can you deduct as a cost of goods sold? The answer is that it was $30,000. You cannot deduct inventory if you have not sold it yet. You don't need to do this anymore. So if you're a business owner whose gross receipts are under $31 million, okay, you are considered by the IRS a small business owner. Wow, okay. So the new way, let's say you buy inventory of $100,000. You were only able to sell $30,000 worth of inventory, but now you have $70,000 worth of inventory left over. What can you write off? Well, the answer is under the new way, you can write off the entire $100,000. I'm going to show you how you can take this information from this video, apply it to your situation, and basically go to your accountant and be like, hey, I know more than you, and this is what we need to do, and I get a write-off. We'll be back right after this break. Hey, thank you so much for watching my videos so far. I wanted to give you a heads up. I've got this free PDF, 7 tax write-offs that every S corporation business owner must know. The link to this free PDF is down below in the description. So to make sure to download it, that's it. Now let's get back to the video. All right, welcome back. By the way, if you're enjoying this video and you think another business owner may enjoy this video, please share it with them, send them a link, click the share button, subscribe yourself, as I have a lot of tax strategies on my channel to help you, the business owner, save money on taxes. Now, let's go back to our inventory. So again, we're assuming you're making less than $31 million, you're considered a small business owner, and you can apply for non-applicable financial statements, Section 471C. Non-AFS, Section 471C. What's non-AFS? AFS stands for applicable financial statements. Basically, the non-AFS is broken down into 2 branches, okay? Branch number 1 is NIMS. It stands for non-incidental material and supplies, books and records. We're gonna work in books and records because this is a really cool part, but I do want to explain what is non-AMS, okay, in 30 seconds. So non-incidental materials and supplies, IRS says, you know what, if you want to deduct your inventory right away, you have to follow the non-AMS option. And this basically means if you used or consumed your inventory. What does that mean? Let's take, for an example, a bakery, a manufacturing bakery. They produce a lot of bread. So under regular 471 rules, when you buy flour, right, you buy flour to bake that bread, the flour is not tax deductible until the bread is sold. Non-AMS says, you know what, why don't you use it in the bread? You don't have to sell the bread, but as long as you use that flour, you can deduct it. Okay, a little bit better, okay? Now that we understand it, I think it was more than 30 seconds. Let's go with the books and records. This is my favorite one. And this is where I'm going to show you how you can actually follow through on this, okay? Now, IRS says, look, now that we've got this new law, let's follow the books and records method. IRS says, look, you cannot just start deducting inventory. I want to ask you a question, IRS says, right? So, do you deduct inventory right away on your books? Now, I can tell you that most business owners, they don't, because when you have a bookkeeper, you always follow what you report on your taxes. You count up your inventory, you have cost of goods sold, you have ending inventory, so on your books, you don't. If the answer is yes, then IRS says, you know what, you don't need to do anything, just start taking a deduction. Now, let's say the answer is no. In most cases, it is no. IRS says, look, if you're counting ending inventory on your books, then we cannot let you take a deduction. You're like, all right, is there a way around it? And absolutely yes. You can file Form 3115 with the IRS. You let them know, Mr. IRS, I am changing my method of accounting. I used to report ending inventory and not being able to deduct the inventory at the end of the year. Now, I want to be able to deduct it right away, and I'm changing my accounting method. Here's another tricky part about this form. You have to wait for the IRS to approve it, but who wants to wait? As a matter of fact, IRS is so great. I think the IRS is amazing. No, I'm kidding. What I think is amazing is our tax code. IRS says, don't you worry about waiting for us to approve it. Just file the form. We automatically approve it, and you can take a deduction. Ladies and gentlemen, just boom, all right? So this is super, super amazing, and I will show you how we're gonna do this on your tax return in the next 3 minutes right after this break. Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. All right, welcome back from this break. Now in this section right here, we're gonna talk about an example, and we're gonna talk about your specific tax situation to determine how much inventory, how much deduction you can actually discover by watching this video that you can now deduct. Now remember, in order for this to work, for the non-AFS Section 471C to work, your gross receipts have to be less than $31 million. That's number one. Number two, I want you to pull up Form 1125A. So look at your last year's return. So right now we're in 2025. Assuming you haven't filed 2025 return yet, let's look at 2024. So either partnership, S corporation, C corporation, whatever you have, right? Pull it up and look at page, I don't know, maybe 12, 13 of the business tax return. You should find Form 1125A. Look on line 7 of that form, okay? This is going to be mind-boggling, ladies and gentlemen. You're going to find out right now how much money you can save on taxes, okay? So, pull up line 7. That is your ending inventory. In 2024, when you filed your 2024 taxes, that ending inventory, you were not able to take that deduction because you were not following the non-AFS 471C. Now, look at that number on 2024 return line, 2024 tax return, line 7. That ending inventory was not deductible. Now, you probably have a new ending inventory for 2025, which you didn't think you would be able to deduct. Well, guess what? Now you can deduct the entire thing in 2025, whatever your ending inventory, whatever is unsold, because you're going to follow books and records method. Now, determine if you need to file Form 3115. We talked about it. If you have been reporting on your bookkeeping, on your internal accounting, whatever that is, inventory as cost of goods sold, and you were not deducting the ending inventory, that's what I mean exactly, you were not deducting the ending inventory, then you need to file Form 3115. IRS will automatically approve you, which is pretty cool. You just need to make sure that your tax advisor knows, or if you don't have a tax advisor, get yourself a tax advisor, okay? So make sure your accountant knows how to do this. File Form 3115, and you get 100% write-off on that ending inventory by following this. Ladies and gentlemen, you're welcome. All right, if you're watching this video this far, please go ahead and subscribe to my channel, like it, share it with other business owners that you believe will benefit from this amazing tax strategy. And if you don't have a tax advisor, please get yourself a tax advisor and start saving money on taxes.